Okay, let's just dive right into this explainer because we have a massive paradigm shift to unpack today. We're looking at the Federal Reserve under its new chairman, Kevin Warsh, and more importantly, what this actually means for your portfolio. We're basing today's deep dive on the latest special service newsletter from the Macro Butler, which is aptly titled WARSH-INGTON, A Fed Under Stress. Look, if you're an institutional investor or you're managing serious wealth, the rules of the game literally just changed overnight, and you absolutely need to understand how.
Now, what's really fascinating about this quote from the newsletter is the reminder that power at the Fed, it doesn't just transition smoothly. There's no fond farewell or a simple passing of the baton. When a new chair steps in, they bring an entirely new monetary regime with them, and they completely rewrite the rules for institutional investors. Kevin Warsh didn't arrive whispering, "Hey, steady as she goes." No, he arrived promising a regime change, and you better believe the market is already keeping score.
So, here's our roadmap for today's explainer. We'll start with the Warsh doctrine being unveiled. Then we'll look at the immediate market shockwaves, followed by the independent stress test. After that, we'll get into the stagflation macro trap, the institutional investor risks, and finally, wrap up with the Macro Butler's insights. Let's get right to it.
Section 1. The Warsh Doctrine Unveiled. Less talk and a whole lot more action.
So, presiding over his maiden FOMC meeting, Warsh kept rates exactly where they were, sitting at 3.5 to 3.75%. But he dramatically changed the Fed's communication style. By literally amputating the forward guidance from the policy statement, taking a metaphorical pair of scissors to paragraph 4 entirely, he forced the market to experience the thrilling novelty of just not knowing what comes next. Think about it. The market has been totally addicted to being told exactly what to think for years. And now, it's just the facts, exactly as Warsh declared. But here's the kicker. Behind that silence on the actual page, the underlying data is screaming. The Fed's dot plot staged a dramatic about-face, completely erasing the easing bias we saw during the Powell era, where the prior Fed had 0 officials forecasting hikes. Suddenly, bam, we're seeing 9 officials forecasting rate hikes. The dovish wing is completely evaporated. That committee that spent the last quarter eyeing the exit, yeah, now its foot is hovering right over the brake pedal.
Moving on to Section 2. Immediate market shockwaves. We are pricing out the Fed put.
Because, when the Fed stops talking, money definitely starts moving. The Warsh era opened with an immediate sell-off in equities, which was clearly led by the NASDAQ 100. Why? Well, because nothing welcomes a new chair, quite like the market rapidly pricing out the old reliable Fed put. That cozy safety net that investors have relied on for years is suddenly looking very, very frayed.
Meanwhile, a really stark contrast emerged elsewhere. The dollar index puffed its chest out on this hawkish reality, while U.S. 10-year yields spiked upwards. This is just a clear, textbook display of eroding institutional trust in bonds. The market had to absorb the somewhat unfashionable lesson that a central bank run by a guy who says inflation is a choice might actually mean it.
So, just to summarize the immediate fallout we saw, equities went down, the dollar went up, gold took a dip, and Treasury yields spiked. Money markets are suddenly pricing in an 80% probability of a rate hike by September. That completely upends the rate cut fantasy land we were all living in just months ago. The era of easy money, it's being aggressively priced out. Which brings us to Section 3, the independent stress test. It's politics versus policy.
And this highlights the immense structural friction currently squeezing the Fed. Warsh is attempting what looks a lot like Paul Volcker cosplay to fight inflation. A leaner balance sheet, a hawkish tone, and a laser focus on price stability. But this diametrically opposes the demands of the president, who hired him specifically to deliver rate cuts and easier money. So we have one chair, but 2 entirely opposed scripts. And before we all just assume the Fed is this untouchable fortress, it's absolutely critical to understand this timeline. The sacred wall of Fed independence? That wasn't actually a founding feature back in 1913. Back then, the Treasury Secretary was the ex officio chairman. True independence was a hard-won patch installed during the Great Depression in 1935. Fast forward to 2026, and that exact structural patch is facing an unprecedented public stress test. Section 4. The stagflation macro trap. The unsolvable equation. But honestly, the most dangerous element of this regime change isn't just the political pressure. It's the macroeconomic trap that Warsh inherited on day 1. Think back to January. The script called for cooling inflation and steady growth. But then, the February 28th closure of the Strait of Hormuz happened. Thanks to this massive orbital shock, inflation has lurched right back toward 4%. This boxes Warsh into a classic stagflation scenario.
It's an unsolvable equation for a central banker, right? Tightening the taps kills economic growth, but easing up just feeds the inflation monster.
And if we look historically at the relationship between the Fed funds rate and the S&P 500 to oil ratio, it reveals a really hard truth. In every single inflationary bust driven by rising oil prices, the Fed has ultimately been forced to raise rates, regardless of whatever political desires might exist. The cycle dictates the action, plain and simple.
Section 5. Institutional Investor Risks. Navigating the Hazard.
So how exactly does this translate to portfolio risk for institutional investors? First off, we're looking at the death of the reliable Fed put in equities. Secondly, you have to look at the massive danger of U.S. Treasuries right now. They are arguably the most dangerous instrument on the menu today, offering this totally toxic combination of inflation erosion on one side and a rising political risk premium on the other. What used to be the traditional safe haven has become a severe hazard.
Even historically safe assets like gold dipped briefly during all this. Why? Well, it's not because the Fed suddenly inspired confidence, it's because institutions engaged in the oldest forced trade in finance, liquidating your highly liquid winners just to meet margin calls on your losers. It's a very vivid warning of the underlying stress bubbling in the system.
Finally, Section 6, the Macro Butler Insights. Let's get into some final thoughts.
While Warsh's background in family offices definitely gives him a strong understanding of wealth management, successfully navigating this specific collision between geopolitics, domestic politics, and sticky inflation requires clear, highly objective macro analysis. Because at the end of the day, Wall Street's favorite magic trick is just an illusion. The central bank cannot simply wave a wand and create a soft landing when the global fundamentals are violently shifting underneath them. The absolute truth of this new regime is simply this: the Fed does not control the cycle controls the Fed.
To deeply understand these institutional risks and to protect your asset allocation in this wild new regime, you need to contact the Macro Butler at info@themacrobutler.com and visit his website at https:/themacrobutler.com/today. Because as the dust settles on this historic pivot, you really have to ask yourself, is your portfolio actually positioned for a hawkish, stagflationary reality, or are you still trading on the ghost of the Powell era?